right now, and welcome everyone to the Zero Governance Call um, numero 6. Um, would anyone be willing to screen share the redash link so we can just go over some of the numbers?
I'm already doing that.
Okay, excellent. Uh, Thanks a lot, Idanyago. I'm going to hand over the stage to you so you can just begin uh, some analysis of this past week's numbers.
Great to see everyone who's joined. A quick reminder that what we've previously decided was that our priorities are one, maintaining the peg, and two, reducing redemptions. Where we currently stand is that we have seen, and I think the best view of this is to look at the daily fee revenue. We've seen continued revenue for the protocol from both originations and redemptions. However, for the last 2 weeks, we've seen originations and redemptions mostly balancing themselves out and bouncing back and forth between the two of them. This has meant that we've seen the total supply of ZUSD mostly remain flat, and a small reduction in the number of lines of credit in total. The upshot of this from a protocol perspective has been continued increase in protocol revenue, where protocol revenue is now heading back above 20% for on average, and even higher than that, close to 25% for those who are max staking, which is very, very significant. Now, another aspect to look at here is the stability pool. As of Monday, the stability pool now provides a 5% reward. We have started to publicize that, and we should be looking to promote that today and going forward. And what we're looking to see is a significant increase in the ZUSD in the stability pool, because that would mean driving demand to the stability pool. Now, this is a very attractive deal. You can bring in stable coins or acquire sovereign dollars some other way, deposit them into the stability pool, and earn 5% yield guaranteed in SOV. You can then stack on top of that the potentially 25% APR by taking that SOV and staking it. So your base yield, just taking those two things into consideration, is potentially 30% annualized. And at effectively zero risk. It's outside of your potential exposure to Bitcoin, which we'll discuss in a second, but also some smart contract risk or something like that. So very low risk, high yield strategy, which on top of which would be layered revenue from liquidations, which can also be very significant, and in fact could overwhelm and be more significant than that 35% yield. It's there are it's a very powerful opportunity, and so far we haven't seen, although this has been for just a day, we haven't seen significant uptake of it. So we should be, all of us, communicating this opportunity, because it is people who are participating in this yield can actually, by purchasing sovereign dollars and then allowing us to increase the amount of originations, continue to drive that yield for the protocol. So it's not a perpetual motion machine. This is revenue that is being driven by the protocol. And then finally, in terms of the sovereign dollar, what we have been seeing in terms of the sovereign dollar peg is it has been mostly over the last week and a bit trending below peg. And what we would like to see is it return to peg. And so I think what we should be looking for is to see an increase in the amount of ZUSD in the stability pool. I think on that basis, we could see Exchequer seek to buy up some sovereign dollars over the course of the coming days or potentially week. Make sure that we get the peg below 1% deviation, and then reduce from 1.9% to, I would propose, perhaps 1% the redemption fee, so that we can significantly reduce the redemption fee and in that respect preserve the peg. So that's, that last part is my personal view. The rest is just the data. And I think with that we can open it up to discussion.
Didn't we agree to reduce redemption to 1.4 or 1.5 last call?
Yes, and that would have required, so any reduction in those requires a SIP, and I had intended to write that SIP, but it became apparent that writing that SIP would go out at the same time as SIP 61, and upon consideration, didn't want to have multiple moving parts going out at the same time, and so I decided not to write the SIP, and so it was a difference of I would have written that SIP and published it at the same time as SIP 61 was happening, so I preferred not to do that. But I think we're now positioned to do that.
Okay.
For SOV staking. So though I would point out, looking at this chart again, we've seen consistently above 6% since August, and consistently above 12% since November. So that's 6 months now, and this is 8 months. And then going back a year, we've seen basically 5% consistently being the kind of floor. And just historically, even when prices were, I think, beyond where they should have been, we've seen yield in the vicinity of 3 to 5%. So even if the price of SOV were to escalate very quickly, there's a lot of room above 5%. So we may see the yield go from, and I think it should, right? The yield should not be 30%. The only reason that the yield is 30% right now is because SOV, from this perspective, is massively undervalued. The protocol is generating enough revenue that at market rates of expected yield, we should see more people purchasing SOV and staking. So when I say this isn't a perpetual motion machine, we should expect and we should want to see this yield normalize and go down through the increase in the price of SOV.
Questions from the other listeners here?
This is one digit. Just a quick comment on that. It'll also go down as more people stake and figure out that they ought to do that.
Correct. This is one and the same, right? So more people staking would mean that more SOV is being acquired, which would mean that the price of SOV is going up. And so the mechanism here is, as you theoretically, right? If the market was full information and rational, what you would see emerge is an expected yield, and basically a yield curve that people were willing to acquire SOV at. And when revenue increased, you would see an increase in purchase and staking of SOV in order to capture that increased marginal yield. I think we're not quite there yet, probably because of low information in the market and uncertainty as to the sustainability of the yield. But I think as time goes by, we are collecting more and more information that indicates that there is a persistent opportunity here, and so we should be looking to see that achieve equilibrium.
I have a few small comments. I think we're getting to the point, especially with the stability pool subsidies, where we have to kind of start pushing the bird out of the nest, so to speak. And so I would like to see us not only reduce the redemption fee, which it sounds like we're trending in that direction, but also look to push down, again, this origination fee. I stand by my position that I think 5% is far too high. And I think as we've gone on these calls the past few weeks, there's kind of this tone that it's like, oh, revenue has continued to maintain. And like every time I hear that, I'm like, no, not really. Like we've seen these spurts of big revenue days, but generally the trend has been down. And I think that we need to lower the origination fee to not only do I think that will net lead to more revenue, but I think even if hypothetically we were bringing in less revenue, we're potentially bringing in more users. And we need to start scaling and bringing in users and getting more eyeballs on the protocol rather than just trying to maximize the profitability. And I think that, if a few of these redemptions happen, it is what it is. So the long short of what I'm saying here is time to push the bird out of the nest. Let's start lowering these fees, normalizing them, bringing more eyeballs on. I think we're ready to do that.
David, if you're volunteering to put your Bitcoin into the lowest collateral ratio line of credit so that you can absorb those redemptions, I'm sure everybody would be happy to let the redemptions rip. But I don't think you're volunteering to do that. And so I think we have to take all of the different stakeholders' views into consideration, and make a decision that's considerate and really responsible for the line of credit owners who have an interest in not being redeemed against.
That is a super fair point, and I know where you guys are coming from, and I don't want to diminish from the issue at hand, but I would prefer to start trending towards the kind of market regulating itself rather than us trying to compel certain behavior. I think it's been awesome that the teams kind of put these small disclaimers on the line of credit that says, hey, acknowledge that your line of credit could be redeemed against. I also, John, I have put forward a potential solution where Exchequer could act as a buffer on the redemption. So I'm not just completely sitting here and kind of, shouting at everybody to say, just like lower the origination fees entirely. But I would like to kind of push us in that direction. So I'm just providing a counter view.
This is one digit. One more comment about that. If you look at the total ZUSD supply, it hasn't gone up in the last couple of weeks. It's actually lower. And so what that's telling us is that every dollar that's being borrowed is being redeemed and then some right now. So, this does kind of go along with what Light was saying, that even, we may be able to make money off of that, but is that really good for users? Obviously not in the short run. Is it good for the reputation of the protocol in the long run? I don't know. But the reality is that we are minting more dollars than we're able to absorb right now, because every one of those dollars is being redeemed and burned. Which I think suggests keeping the origination fee high until we see the redemptions, at least until we see the total supply going up, and that being
I think there's also an additional indicator, which is to what extent are people borrowing using the lending pool, the variable interest lending pool. So taking a look at that, we're seeing a borrow APY right now of 6.8%, and a supply APY of 0.4%. So one thing that we might want to consider is adjusting this to reduce the borrow APY and incentivize the supply APY. So right now, what we're seeing is that the borrow APY is 6.8%, and this is an algorithm that, again, Bitocracy is able to change, and it's at that when we have only 5% borrowed of the total 100,000 provided. So the current algo is quickly accelerating the borrow APY, and it hasn't yet reflected in the supply APY, because that's being divided by all of the providers, right? So there's a high APY being paid by the borrowers, but it's being divided by a much larger number of suppliers. So there's the potential to look at normalizing this in order to try and encourage, in the first instance, borrow, which can then be converted into a higher ratio of supplied to borrowed. Again, not it's not necessarily trivial, but there is that opportunity, and looking at this as an additional indicator can tell us a little bit about opportunities in demand. Now, I think one of the challenges that we have is that we currently have a lot of opportunities which are possibly not well understood by a large enough number of potential participants, and so there's also sort of a question here of how rapidly and in what ways are we able to educate people about the opportunities that are available here to, for example, earn yield by lending, and convert that into activity. So one other indicator which I would point out is that the XUSD curve is currently providing a very high interest rate, because it's got a 50% borrow, and people are willing to pay and are paying 14% annualized interest, which tells us that there is a market which is willing to pay 14%, is used to doing it on XUSD or on USDT, is not aware of the fact that they can borrow more cheaply, or is not taking advantage of the fact they can borrow more cheaply using sovereign dollar, and is substantially higher than 5%. There's quite a few moving parts here, and I think having more people aware of the opportunities is a big part of the puzzle at this point. That's certainly part of it. Look, there are questions about how this scales at larger amounts, but there's significant profitable slack in the system right now, which is not being properly arbitraged.
Hey, Techro. Can I make a quick comment, please? Techro. This is Techro. Hi. Um, Regarding the yield for the XUSD lending pool, so it is possible to do margin trading on the Sovereign Alpha debt with XUSD, but it is not possible yet to do it with dollar. And maybe we should enable it for dollar in order to increase the dollar demand and get better yields in the lending pool.
Light, what is the status of that? I may be mistakenly under the impression that we had enabled margin trading with sovereign dollar.
It has not been enabled yet. As far as I know, the relevant devs are currently evaluating the effort for adding it to the limit order system and the watcher.
Is it too late to discuss maybe rethinking the priorities there?
It's not a question of rethinking the priorities. It's just a question of assessing the effort and then determining where it fits into the priorities.
But if the demand is really high when it comes to, leveraging with stablecoins, perhaps that might lend to enabling margin trading with sovereign dollars more important than what they're currently looking at. It's just an idea.
Well, I can't say one of the key priorities right now is making it much simpler to bring stablecoins into the system, at least from a UI perspective. Acquire sovereign dollars and then use those dollars within the system, particularly the stability pool. I think there is a lot of I think a lot of the frictions here are UI frictions. So it's a combination of UI frictions and sort of market awareness frictions that are slowing down the rate at which the system is sort of economically normalizing. And I think I would address the point raised by David Saroy with regards to that, which is there is on a from a first principles basis substantial slack and a ability to really scale the demand for sovereign dollars through lending pool and AMM, and in particular through the stability pool. And we need to see that being taken advantage of, because otherwise we're going to be pushing on a string. So we can, for example, reduce the origination fee and see an increase in originations, but we need the other side of the market to also be able to react to that, and that is in terms of purchasing SOV and staking it, and in terms of bringing liquidity in the form of stable coins or potentially Bitcoin to acquire those sovereign dollars. And and so we need to see the connective tissue there work. Otherwise, what is theoretically the right decision could practically, from a practical perspective, not work.
I'm speaking out loud here, and I'm taking in what John said, and I again think it's very valid. But I'm wondering, is there an assumption that if we reduced origination fees and allowed for more minting of dollar, that it would automatically want to bridge off? I would think that people would do like a high level economic calculation and say, oh, if I could borrow against my Bitcoin, but it cost me 5% in origination fee, and I can only earn 5% in the stability pool, that's essentially net zero. And I know the counter would then be like, well, they can bridge through Babelfish, which bring in stable coins that way, and then earn the 5% and not incur the origination fee. But I'm just wondering if the yields that we're offering are somewhat mitigated by this origination fee, where it's not as appetizing for people to put dollar in because they assume that they're having to pay this origination fee. I don't know. I'm speaking out loud there, and wonder if maybe that's part of the impediment that's causing these disconnects that you guys are talking about. It's like, why are people not picking up these arbitrage opportunities?
To my view, we don't. I wouldn't want to see the primary use case here being I generate. I borrow sovereign dollars and then immediately deposit them into the stability pool, because that would crowd out the ability for users to borrow from the stability pool. To borrow from zero and use those funds as a way of putting their Bitcoin to work. And that would be a little bit of a perpetual motion machine. It would mean that we are rewarding, effectively subsidizing people for coming, borrowing funds, and putting them into the stability pool, and that is exactly what Liquidity did, and they are, they've spent a lot of time subsidizing that activity, and I don't think they've seen a lot of growth of organic demand, which is what we would like to see. So I'm wary of encouraging that particular use case. The use case that I think we want to see is people using probably stable coins primarily to acquire sovereign dollars, and therefore providing, the importing the stable value, which allows people to export the value that they're borrowing and turn it into fiat or do whatever it is that they want to do with it, because we want to create that connective tissue between sovereign dollars and the ability to spend in the real world. Otherwise, we're creating an extremely self-referential system.
Just to add to that, 65% of LUSD is in their stability pool, which, the whole purpose of the stability pool from a design perspective is to make the borrowing protocol work. And so if you've got 2/3 of it just there, you're borrowing just to make it work, you're not really doing anything. So it would be great if we could attract stable coins from outside. And I think that's where we need to be communicating well.
Yeah, and I would add to that the majority of the rest is in various curve-like pools, which are also incentivized by earning liquidity tokens. So the sort of organic activity, the actual use of LUSD as a currency hasn't really developed, and I think it hasn't developed because it's basically been a sort of self-referential yield farming machine.
Right.
the indicators that I think we should be looking for is an increase in the value in the stability pool, and ideally also, although I think we could be more forgiving on this in the first instance, an increase in the purchases of sovereign dollar with BTC, and more importantly to my mind, the purchases of sovereign dollar via Babelfish with imported external stables, fiat stables primarily.
I think more directly we can look at whether the total supply of ZUSD or dollars increasing, and that means that people are finding other uses for it other than to redeem it. And then also we can look at the peg, and if the peg is staying close to $1, then that tells us that we've that's one way of saying we're slowing down redemptions. So that's where we're going to be.
I'd second that. No, I think we can be more aggressive than that. What I would suggest, and I think I'm taking a lot of this. I'm sort of stealing John Light's idea here, but I think Exchequer can look to provide to purchase sovereign dollars off market, reduce the deviation from PIG to below 1%. I think this could be done on a relatively short-term basis, while we work hard to, let the world know that there's basically money on the table here, 30% yield, close to zero risk, and reduce redemptions, the redemption fee to at least 1%, and maybe England EU, while I'm speaking, can create a tiny little poll around this, which, with our little thumbs up or symbols that we can do, because the advantage here would be that we can reduce the redemptions, improve the PEG, and try to, and I think that would also help create the correct environment for people to actually be more comfortable buying sovereign dollars and placing them in the stability pool. And it would also, just the fact that we're planning to do that would, I think, also introduce an additional arbitrage opportunity, because right now it's cheap to buy sovereign dollars. You're basically getting them at a discount. And so you can increase your yield even further by buying the sovereign dollars now, in the knowledge that we're planning to reduce the redemption fee and therefore reduce deviation from PEG.
Well, that would be speculative, because there's no guarantee Bitocracy approves it. But if someone wants to speculate around that, they're free to do so. I think in terms of how to frame the question, it would simply be, should the redemption fee floor be reduced from 1.9% to 1%? Thumbs up, yes. thumbs down, no, no meaning leave it how it is, since there are no other options on the table.
I mean, there is another option on the table. David Soroy explicitly suggested reducing the stability fee, and I think he was implicitly suggesting reducing it to 2.5%. There was, admittedly, I think, little indication of consensus around that, but there was another proposal.
The origination fee?
Correct. David, you feel free to.
I would say that would be a second poll question. The question is, would you consider those independently or as a bundle package? Because maybe some people agree with one but disagree with the other, or would only go along with one if they also got the other.
Why don't we,
for
for
simplicity's
now,
sake, you just consider them independently?
Yeah, I'm in agreement with John. I think for now, maybe just do the redemption fee one, and then let me see if I can put a more coherent argument together that's kind of backed by some of the data, and I'll post it in the forum if I can justify an argument for reducing the redemption fee, and then we can go from there.
All right, there appears to be an emerging near consensus on this, so I'm going to write up a SIP, which I expect to publish.
The one thumbs down was England, and I don't want to speak for him, but I think he just put it there.
I see. All right, so we basically have a clear recommendation from this meeting that we can put forward to Bitocracy.
Later.
Do you want to get a temp check, David? Later? Okay.
We have the forum, which provides us a great opportunity to discuss this in depth, even outside of these calls. So I don't want us to rely purely on calls. They're also susceptible to charismatic leaders / people who speak loudest / people who speak the most, of which I'm fully aware that during this call I was guilty of. So it's just, I think there's an advantage to written conversation. If I can just say one last thing. We're in a very interesting position here. I think we've built something really cool. There's clear demand for it. There's a two-sided market. One side of that market is extremely potentially profitable. And so I'm saying this to you guys here and to anyone listening. I think there's a collective effort that can be made here to take advantage of this ourselves, but even more importantly, to let people know that there's sort of like unknown or not well enough publicized money on the table opportunity, because we do want to see normalization. We do want to see the market forces start to be more impactful in sovereign. That's the last thing I wanted to say. Thanks, Inglandia, for providing me the opportunity.
Thank you, Sovryns, for attending. Thanks for voting. Stay sovereign. Have a good week. Over and out.
Stay sovereign.